Welcome back to Gimme Some Truth. Today we are talking about a very timely topic, the war in Iran and the effects that has not only on the markets, but also on the economy as it stands today. So we are in the middle of this. So obviously this is changing very quickly. And so our take today is going to be a little bit more about just our thoughts in terms of historically how this affects the markets and where we potentially see this going, but again, changing very, very quickly. And so it's literally hard to predict what's going to happen an hour from now, let alone 6 months from now. But first off, your first blush reactions, where we're at, how the market reacted. We're a week into it now, so kind of help people understand kind of what happened to this point, right?
Yeah, I mean, obviously, everyone's pretty aware of how the conflict has kind of shaken out to this point, and right. I do want to say that we're not taking any sort of political stance or anything on the war and the conflict that's going on right now. We're just trying to digest what we've seen so far and the kind of impact it could have on people's portfolios, what we've seen a little bit in the past, and one little lighthearted thing to start, which was every once in a while somebody will make a prediction or say something, and then something happens. So we saw this incredible escalation in oil prices that happened literally like overnight. So on Sunday night, all of a sudden the oil prices just started to explode upward. And then Jim Cramer said, "A sudden oil shock is always bad for stocks. I don't see a path to de-escalation." Then Monday happens, and Trump gets on camera and says that the Iran war is nearing the end here. And all of a sudden, oil crashes 30% since this tweet. The market ends up on the day when the futures were looking really brutal. Jim Cramer has a little bit of egg on his face. There's always this sort of inverse Cramer trade that people talk about, that whenever he talks up stocks or things like that, you should do the opposite of what he says to do. And the opposite just happened. So a lot of people had a lot of fun on the internet with that one. But back to more of the Iran conflict. Right now, obviously, it means a lot for oil prices because we have the Straits of Hormuz in there. And, obviously a big portion of oil runs through that region.
Yeah, and I think that going back to the Cramer comment for just a minute, I think it's a microcosm for how difficult it is to try to be predictive in times like this, and how it doesn't take much to get a call wrong and have it be very painful. And so I think that's the speed at which this is changing, and this is what happens during these times. And now you have some stats in terms of the Gulf War and things like that. But these things happen so quickly, and this news comes out so fast, that trying to be predictive in any way, shape, or form, I think is a very dangerous thing to do in times when it's so charged up the way it is right now.
Yeah, I mean, certain things are truths in these things, like, commonly, volatility indexes will peak when the conflict is at its peak, so when the uncertainty is at its peak, the VIX spikes, and obviously that usually is negative for stocks. So there have been very, very short periods of time where stocks have actually gone up. That was like the Iraq war. When the invasion happened, stocks actually went up, but that was being bantered about and talked about for months and months prior to that. So the Iran war escalation happened quickly, and all of a sudden bombs were being dropped, and usually that is negative for stocks. This was no different. When we had the Gulf War, the S&P fell about 20% when we had the Gulf War in 1990 and 1991. Around 9/11, we had the 9/11 event. Stocks fell 12% in 1 week. Russia, Ukraine, the S&P fell 12% from February to March. And then the Israel-Hamas conflict in October of 2023, the S&P dipped 2 to 3% during that period of time. So you could see a consistent negative initial reaction. 12 months later, in many cases, in the first one that I referenced, 29% after the war began, when we had the Iraq conflict, 9/11, it had recovered in 1 month even. And so there were some definite times where the recovery has happened almost every time 12 months out.
Yeah, I think in a weird way too, it almost parallels what happened during COVID, right? COVID, it was such a shock, it was such an uncertain event, and so it dropped immediately, and then within months it kind of found its legs and got back, and I think that speaks to what we talk to clients about a great deal, which is the market hates more than anything else uncertainty. The market would prefer bad news versus uncertain news because it doesn't know how to digest uncertainty, and that's what events like this bring, is a tremendous amount of uncertainty. As you said, 20% of the world oil supply passes through that strait. If that gets cut off for a day or a week or a month, those are big events when that happens. And so, and then if that were to happen and then open back up, I mean, again, you can see that the volatility that could create within the oil market. And so it's, again, trying to become predictive in these periods of time, I think it's not only is it a futile attempt, I think it's a dangerous thing to try to do. It
is. And also you look at oil prices directly drag GDP. So,
correct.
If you see one estimate that I saw, 10% increase in oil prices, and you see about a drag of 0.1 to 0.2% on U.S. GDP.
Yeah.
So, you see that over time. So if we saw really high oil prices, that would lead to negative GDP prints. Now it might be short term, but it's still a negative detractor because it's a tax kind of. Things are a little different now, though. The U.S. is a bit more of an oil exporter, natural gas exporter. Right. So, and they've got now with the Venezuela conflict we have earlier, we have a bit more supply that we can access as well, and a little bit more profitability for the country. So things are a little different than they were perhaps 10 years ago. When we were talking, I think it was about 15 years ago, we were talking about peak oil.
Right.
Doesn't appear that we're anywhere near that right now. So, we're in a situation that's a little bit different. I want to talk a little bit about, safe haven assets during this period of time. What tends to do well? What I'm not saying is that you should go out and, reconstitute your portfolio significantly during times like this. But, if you have allocations to certain asset classes, they tend to do a bit better during this period of time. So, for example, gold is the shining example of that. Yeah. It's our shiny little yellow fear bar. It does tend to do well during these periods of time. Gold's been on a really big run the last 12 months. But that being said, that's a safe haven asset usually. And then U.S. Treasuries, which have also increased, yields have increased as well, with kind of that flight to safety trade.
Yeah, the 10-year had an interesting, last 6 months, last 12 months. I mean, it kind of was in the low fours, and then it actually got down into the high threes. You actually saw mortgage rates for literally one day touch under 6% on the 30-year fixed. It's since bounced back up a little bit as a result of what's going on. And so Treasuries ends up being kind of one of those, again, barometers, if you will, in terms of what's going on. And so as well as the dollar too, I think, the dollar strengthened as a result. So some of those things are a little bit easier to kind of guess, if you will, to guess correctly. But at the same time, it's even within that there's uncertainty, because the gold, that's a good example, right? Gold's run up a tremendous amount. So will it continue to appreciate even though it's run up the way it has? I mean, does it go from 5 to 6 or 5 to 7? Maybe, but we're not in a normal time with gold. I mean, it's doubled in value already. I mean, more so than that. So is it still going to be that fear asset? I guess those are some of the things that are hard to get our arms around.
Yeah, and in general too, dollar-denominated assets, the U.S. dollar just in general has strengthened up here. It's been on a weakening cycle the last 12 months, a significant weakening cycle for a variety of different reasons, geopolitical reasons included. And so that, has definitely contributed to, the weakening of the dollar. And then all of a sudden this conflict happens and we see a strengthening of the dollar. Yeah. And so we'll see if that persists as well. And then generally defense stocks, as you can kind of imagine, defense stocks tend to do well during these periods of time.
Value tends to do better than growth.
Value tends to do better than growth. And I say defense stocks from two different ways. Defense stocks tend to do well, and defensive stocks tend to do well during those periods of time. But yeah, we were seeing a bit more of those do better. Those names do better as well that you would expect in the defense sector. And then there's some private stocks that are obviously rallying under this sort of news as well, underneath things. So, companies like Anduril and that are private companies that have a lot to do with defense and defense contracts. And then stocks like Palantir, which provides a lot of data to the U.S. government as far as their defense, they tend to do well as well during these periods of time.
Yeah, let's. Why don't we close it out with where we see it potentially going? Again, I know this is a dangerous place to go because we just said don't predict the future. But if we realize what the headlines have been telling us literally within the last minutes and hours, if we are closer to the end than the beginning, obviously that's a positive message to the markets. I guess I'll just ask the question: if that were to happen, is there a soft landing? I get, to get to steal some excuse me, some Federal Reserve speak for the last couple of years. Is there a soft landing that we can see, at least within the markets? And again, we're not talking about it from a geopolitical or from a social standpoint. We're talking about just purely from an economic standpoint. Is there a soft landing somewhere there?
Yeah, I mean, I'll use another word with the Fed. Maybe this is just transitory, and
Sure.
you could say like,
Right.
okay, we've gone through and we've seen, this year, 2026. We've seen the administration be a bit more activist from the geopolitical situation. I think that's a reasonable fact to say. And so when we take a look at this, is this just one more stop on the way of multiple stops that we have, or is this one of the big moves where all of a sudden we're going to see a bit more calm? And so I think that will have a lot to do with where markets go from here. Generally, and let's look at it from the lens of, war is usually stimulative towards stocks, especially long-term conflicts. I don't see that happening in this situation. I think the administration has said strongly that they don't want to get into a long war. Now, they might not be able to dictate that at all.
Right.
So generally, though, the money printer turns on, and as things escalate and money pours into defense, that's usually stimulative for stocks. But that comes at a cost later on as well. So could it be that this is sort of like transitory or shorter term event? Yes, I would tend to think that would be the case in this situation as well. I think that this is, again, why we diversify.
Yeah.
And this is, again, why, sometimes asset classes and we as advisors sometimes have this sort of, sometimes we issue certain assets and we're like, I don't like dealing with gold. It goes through these periods of time where it goes through these 10-year cycles where it does nothing,
Right.
And then when you need it, it's there. And then all of a sudden you go, wow, I'm really happy that I had that. And so you have to have a lot of patience, and you have to understand that these asset classes may go through really long cycles that test your patience. And if you do that, a lot of times you will be rewarded in the end over certain periods of time. So, should you have a little gold in your portfolio? Should you have some of these other assets? Perhaps, for these diversifying reasons, but you just have to be steeled and know that there might be long periods of time where they're just dogs. And I put value in that camp too. I put international stocks in that camp. Right now, we've never had more international stocks in our portfolio than we ever have. And I think the reason for that is, we believe strongly in diversification. We've always had those there.
Yeah.
And finally, the sun is shining on some of those. And I think all these other asset classes like gold and others, that could be the same thing that happens there.
Yeah, recency bias is a real thing. I mean, if you just made the statement that at some point, growth will fall out of favor. I mean, it almost sounds silly to say that, right? Because of where we're at right now. At some point, growth will fall out of favor and value will be the darling place again. It sounds weird to say, but that will happen. And so this idea of kind of recency bias or kind of getting stuck within what's popular today and not realizing that at some point that trade will cycle out and another trade will come in. And so I think you're exactly right. I mean, these times are why we diversify, and it's these times that why we feel adamant about having trusted advisors that you can lean on, if for no other reason than just being able to have a conversation, just to say, hey, what's going on? I'm getting a little freaked out. What do you think we should do? Where's my risk profile at right now? What is my allocation at right now? How much do I have by way of gold and by way of treasuries and things like that? And I think that it behooves people to lean into that now, because these are trying times to stay on the course and to have resolve within what we're doing with your money.
Yeah, and coming soon to a podcast near you, a little bit more of a discussion around that exact point that you made, which is, can value come back into favor? Can value become the new growth? And will AI actually stop the growth train, which is counterintuitive what you might think, and make value sexy again?
Yeah, it's interesting because the Fed's dealing with that right now, trying to figure out that the entire AI question mark, I guess I will say, in terms of it's likely to cut jobs, potentially significantly cut jobs, but yet potentially also be stimulative to the economy. So it's this weird position that the Fed finds itself in right now, and so I think that'll have a lot to do moving forward with the results of 26, 27, 28 potentially. But this conflict could also drag on and could also have influences, well beyond what we think. And so again, we felt strong the desire to get a message out and to let people know that this is obviously something we're watching, having conversations every day, within the office. And while we don't have the answers, and while even Jim Cramer does not have the answers, we've been through some of these things before, and the history that Clint and I have managing money, we've seen some of these things before, and so it's new each time it happens. They say history doesn't repeat itself, but it rhymes. So there are similarities that we can draw back to when going through times like this. So again, if you are looking for some level of assurance or at least conversation, this is why we're here. So please let us know if you have questions or concerns. If you have comments on this, please let us know. Thanks again for tuning into another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.